Okay, welcome back again. This is the webinar on buying investment property in the Dallas, Texas market. My name is Shashank Shekhar. I am the MBA. I have an MBA and I'm the CEO of Arcus Lending. I am joined by two other panelists, which I will introduce to you later in the webinar. But before we move forward, can you use the chat button on the right and just make sure that you could listen to me and you can see my screen with the PowerPoint slide. Just want to make sure that that's taken care of, and then we'll move forward. So you have a chat and a question button on your right. Just chime in there and let me know that if you can hear me and if you can see my screen. Okay, I don't see anyone chiming in.
Shashank, we are receiving several responses.
Okay, so they
nobody has complained.
Can they hear me and can they see my slides?
Yeah, most of them have responded that they can see it.
Okay, that's perfect. So let's move on. Just a couple of housekeeping stuff here. We are recording this webinar, so if you don't want to take notes, that's totally fine. We will be sending you a copy of the webinar. And on your right is, of course, the chat button, which we will also use as question and answer. So unless something goes wrong and the screen freezes or you can't hear us, of course, let us know during the webinar. If not, then try to hold on to the questions if it's not urgent towards the end so that we can finish this on time. We're trying to finish this in about 60 minutes. And then we'll take all the questions at the end. And if there is anything that we are not able to answer because of the lack of time, we will get back to you in next couple of days. So let's get started here. So the first slide that I want to talk about, Andrew Carnegie, a lot of you would have heard about him. He was one of the first billionaires. And it was way back in the early 20th century when 90% of all wealthy people became so by owning real estate. And I know a lot have changed in last 3 or 4 decades because of the tech industry and everything else. But there is still a lot of wealth to be made in real estate. And we'll talk about how you can get started on that path. This is our agenda. When you signed up for this webinar, I guess this is what you were expecting. We mentioned that we will teach you about all this, which is the fundamentals of investing in real estate. How do you find the right property? When you do find it, how do you finance it? Then we'll have our tax expert come in to talk about what are the tax implications of doing it. And then we'll talk about once you've bought the property, you've figured out the tax implications, how do you manage the property? That's the property management angle of it. We'll get down to doing some numbers at the end, and during the presentation we'll also briefly talk about why the Dallas market and why it makes sense to maybe invest in this market. One of the things that happens in the real estate investing is that it's not a get-rich-quick scheme, as we are not trying to buy a stock that will double tomorrow or something. So there are no overnight riches. They are really, as we'll go along the webinar, you will realize that there is no silver bullet that comes with it. And it's hard work, paying attention, understanding the fundamentals. And this is how money is made. Some of you would have seen these slides that a lot of we start as an employee. So we have a job. Some of us try to move from being an employee to become self-employed, but we still work like an employee. Sometimes, as in I'm self-employed, I can talk about that. Sometimes we work actually more than an employee. And then once you have a large business, then you let the business work for you. And finally, I think the top end of how money is made is that when you're an investor, when money works for you. So you have some investments where you're not even doing most of the work, and you get the cash flow from that investment. So before moving forward, just wanted to quickly, briefly tell you about who I am, so that if you are on the webinar, you haven't heard about me before, just making sure that you understand that you are hearing from someone credible. I won't go into the details of all these bullets. Most of you can read it there, but I'm one of the top mortgage professionals in the country and have been featured on most of the major media in the country. So why invest in real estate? This is one of my favorite examples of just to get you started on the right front and just compare real estate investing with, say, investing in stocks or gold or commodities or anything else that you could be investing in. If you look at option one, it says if you buy $40,000 in anything else, whether it's stocks or gold or art or as I said, commodities, and the market goes up 10%, you get $4,000 of benefit in that investment, which is 10% return on investment. But if the same thing were to happen in real estate, so you buy a $200,000 property, again with the same investment because you're putting 20% down in that, and now if the market goes up by 10%, which is 20,000 because you're now calculating it on the real estate price, then your return on investment is 50% because you only invested 40,000 and you still got 20,000 out of it. So that's one of my really simple and an easy way to explain why investing in real estate has way more leverage than most of the other investments that either you could be making right now or you could be thinking of making in the future. And that's one of the reasons why I like investing in real estate. So at this point of time, as I said, the agenda is to move from teaching you some fundamentals of real estate investing on why it's important to invest there to start with finding the right real estate. As where do you find it, how do you find it, which is a right rental real estate property. And to do that, I would like to bring in my first esteemed panelist here on the webinar, Sanjay Joshi. He is, of course, he's a personal friend, but also a broker of classic management. And he has over 14 years of experience in selling real estate in the Dallas markets. There are very few people who know about buying property for either investment or primary residence more than Sanjay does. And to top it all, he also runs a property management company, so he'll be able to give you a full picture of from buying real estate, which he'll be talking about right now, and then we'll bring him at the end where he'll be talking about the property management angle of it. So over to you, Sanjay, if you can teach our attendees on what are some of the things that they should be looking at when they're thinking of buying an investment property which is good for them.
Thanks, Shashank. Yeah, it's when we're doing the real estate investment, it's very important that the property which we are identifying is it's a good property. And a lot of time, the clients, they come to me and they say, well, suggest us something which we want to buy for ourselves, and then it should also be an investment property. And most of the time, my answer is that you should keep it separate, the property for yourself versus the investment property, because if it's investment property, we are looking at completely from the cash flow perspective, from the investment perspective. And the things, which I pay great attention to, and I have helped a lot of clients, when I'm saying a lot, really good number. And, they have invested in the real estate, and a lot of people now, they have 6, 7, 10 homes. They have a little portfolio. And some of the factors or some of the things, which I paid great attention to identifying the properties for my client was, first of all, the place where we are buying the property, how populated it is. It doesn't matter, whether it is in Fort Worth or Arlington or Capel or, from the property perspective, but we just want to pay attention to if it's on the countryside or if it's in the suburbs or, what's the population of that area. And that helped with the, finding the tenant. The second thing is, which I pay attention to, the rental comps in the area, to see that if the property in that particular area gets rented quickly or it takes time. The third thing which we pay attention to is what are the other factors, which impact that particular area. Like if there is a big employer, for example, if you're, like say you're investing, and again it also depends on what kind of property we are buying. But say we are buying a property for $140,000, $150,000 property, and if we see a GM plant or we see a some kind of a big production plant, we know that there would be a lot of people who wants to, who are working at that plant, and then they would be our potential good clients. Like say, for example, if it's in Plano and we do see that, there is a HP's office there, of course, the $1,500, the $150,000 property may not work well there, but if we have, like say, $200,000 to $300,000 property, we may have find the tenants who would find that house okay for their needs, and it's close to the employer. required. So those kind of things. And the school is another important factor which impacts our rental time quite a bit. If there is an elementary school or middle school closer by, that really helps in getting the good tenant. Other factors we pay attention to is, how close are the shopping places? Walmart, Target, shopping, the grocery stores, those kind of things. Then after we do all this research, then we say, okay, well, this area seems good, so we have to find the good property in this particular area. Then we get into, what kind of floor plan, whether we should go with a single story, two-story, and again, depending on the area, we suggest or we identify the floor plan, we is very generic, which is most of the people, they like it, and it's easy for us to find the tenant. And then also, we pay attention to what are the features we are looking at in the floor plan, where we get the tenants excited. And then the swimming pool, that is, personally speaking, I prefer the rental property with no pool. And just because of the liability reasons, we can get the pool, but then there is a lot of headache with that. So that is the factor we pay attention to.
So that's quite an exhaustive list, Sanjay. Is that if someone who's thinking of buying for the first time, I'm sure, as in when I did not have an investment property, I could not think of a few of these. In fact, even though I have some, even now I find this list quite exhaustive, because this is something that it's very difficult for, say, new investors to think about. How do they figure all this thing out? As in, is this something that say your company or say working with a local real estate agent is it their responsibility to figure all these things out? Because that's a lot of things to look at, especially if you're from out of the area. It's almost impossible to figure these things out. So can you help our attendees figure out where is the best place to kind of figure all these things out and see if the property is a good investment property?
Sure, Shashank. I mean, really speaking, even if you're local, sometimes unless you have the expertise and you know the area well, only then you would be able to identify the right property. See, I mean, you can do the investment, but whether it is a good real estate investment or not, that's a question. And of course, I mean, I'm doing it, helping the clients with the real estate investment for quite some time. So, of course, we do it, and we have done in the past, and we can help the clients. But if I mean, for example, if they want to work with somebody else, that is fine, but still, they have to make sure that the person or the company they are going with should understand all these things, and they can help them with the good advice. But to answer your question, yeah, we are doing that. We are like a full-service brokerage firm, and I have a team of agents, and we do have full-time agents on my payroll, and we help with our client with these kind of properties.
So that's interesting what you just said, Sanjay, because I guess what you're trying to say, and just making sure that I heard you right, is that a same real estate agent or real estate broker who is, say, good with helping people buy their primary residence may not be as good in terms of helping them with investment properties. So are you saying there is you need to be working with someone who understands investment property per se?
You are absolutely right, Shashank. Even, I mean, forget about the other companies. I can talk about our own company. We have quite a bit of number of agents, but I can tell you is we have only few agents who specialize in the investment properties. And it's just the mindset, because the other agents, they just don't understand what, what the clients are looking for. Or, I mean, they will just look at the price of the home and the rental, and that's it. And that's not how it goes. There is a lot of thinking going behind it. It takes a lot of effort and experience to identify the good investment property. And most of the time what I do is I spend time with a couple of my agents, who specialize in the investment property. I help them identify the property, and I explain them that, okay, well, that's what your client is looking for, and then they take it from there. So it's a very specialized area.
That makes sense, because that totally makes sense, because buying a house for living in it, of course, there's a lot of emotional value attached to it, while buying a house for investment properties is mostly a business decision in terms of whether it will make money or not, and if it makes sense to invest into it.
Right. So, and one more thing I want to add to it, Shashank, is, and you will be surprised, and in fact, a lot of our clients may be on this conference call as well, and a lot of our clients, they don't even see the property until, it's been executed and everything. So basically, they rely heavily on our expertise. And I mean, I can tell you that, they're pretty successful. I mean, our clients, and that's why they made the investments over and over.
No, I can vouch for that. As in, I just bought through you, and I hadn't even seen the property, so I totally get that. Let's talk a little bit about the Dallas market. As in, I know I have seen some news headlines coming out that Toyota is moving there, but why else? Why do you think that the Dallas market makes more sense than, say, some of the other markets you may be aware of, or our clients could be from other areas? But what do you see locally being there, which makes this a market for real estate investors?
Well, Shashank, a lot of employers, the reason they're moving their operation here, including Toyota and some other companies, is because they are realizing that the cost of living is still pretty reasonable in Dallas area. And because of that, I mean, if you look at last several years, the countrywide, which is Bank of America now, they moved their operation here. Now Toyota is coming, and there are like some other big companies, they moved their operation in Dallas area. And so it's the reason they're coming here is because the cost of living and the good schools and the good life and everything, and that's driving a lot of people moving to Dallas. That is one factor. The second thing is what I have experienced is there are a lot of consultants. They're making Dallas as their home, and just because of the time difference, you're on the central time zone, and if you're on the California and if you have a client in East Coast, it's very, very difficult. So that is another reason for a lot of consultants to move to Dallas. So I mean, I do see that there are a lot of clients from out of state. They're moving to Dallas Fort Worth, which is really good for the investment properties. That means in the future years we expect there would be more people will be coming in. That means if you have the rental property, your rental time would be less, and you can expect more rents.
So even though the demand has gone up dramatically and looks like it'll continue to go up because next 2 or 3 years, as you rightly say, Toyota is moving in, I've heard FedEx is planning to move in, and other employers are trying to move into that market because it's central. The inventory is still not that huge, and from what I know, it's say less than 2 months of inventory or close to that, which means that there's not so much supply that the market will not appreciate. And so what do you see in terms of inventory there, and what do you see the projection in terms of the appreciation that could happen because of more demand but not that much of a supply?
Yes, Shashank. I mean, it's just the simple economics principle of supply and demand, and it's the supply is. I mean, and I would say if you go like 3 or 4 years ago, I think inventories were similar at that time, but the demand is much more now, and it's just because the number of people moving from out of state to Dallas. So inventories are very, very low, and I don't anticipate that the inventories are going to go up any better in the near future because, again, the homes are limited. I know that there are a lot of home builders. They're trying to build the homes, but most of the time they're a little bit, on the outskirts. But even, when they're building it, Coppell, for example, they're building few, Valley Ranch, Irving area, they're building some, but the price point is very, very high. So again, the inventories are low, and I do see with the number of people, moving into the Dallas, that the inventories are not going to go any better.
Makes sense. So if someone is considering buying in that area, then of course they have to go through this list and make sure it kind of fits into most of the 7-point checker that you just mentioned here. But are there any special areas in the suburbs or somewhere which is kind of favorite for you in terms of real estate investing? Do you think a certain city or a certain zip code or certain suburb is probably more favorable, or the metro area than say the other areas?
Well, Shashank, I mean, when we do the calculations, it's really speaking, to me, when I'm running all these numbers and identifying the areas, it's completely based on the cash flow. And again, with these factors. So, but I can tell you is the client of ours, where they have invested is, it's in the Tarrant County. We have invested in Fort Worth, Arlington, Mansfield, North Richland Hills, Keller. These are the areas. In the Denton County, it's Louisville, Carrollton, Flower Mound, Frisco, part of Frisco. And then in the Dallas County, Mesquite, Garland, Richardson, these areas. And then in Collin County, Wiley, Murphy, Plano, Allen, McKinney. So these Little Allen is part of Denton. So in the Denton County, Little Allen is another good one. So these are the areas where most of the people, they have identified or they have bought the properties. But again, when I'm running the numbers and everything, it's with my 7 checklist, these are the things I'm looking at it. That okay, how fast it can rent? What is the cash flow I'm going to get out of this property? Is it going to be when we rent it, it's the next year I'm going to be getting more rent out of this property, or it's going to be same. So basically, to identify if the demand is going to go higher in that area. These are the things. And then appreciation, if the property is going to appraise, it's going to go up on the value in the near future.
That's amazing, Sanjay. And I think this 7-point checker should be like a real estate investing Bible for someone who's looking into investing. And thanks for chiming in with all the local Dallas market and why do you think that's important. We'll come back to you later in the webinar when we talk about property management. So let's jump onto financing. So again, we are trying to make it go in a flow for you where you have first looked at the real estate and see if it makes sense to invest in it. And then we talked briefly about why the Dallas market makes more sense than some of the other markets which you could be looking at. And Sanjay mentioned about several factors, including also the fact that the upfront cost could be much less because of the price range that you're looking in Dallas markets. There, if I'm not wrong, Sanjay, you could find properties in the $150,000 range, which is, of course, cheaper than, say, if you're thinking in California market or some of the more expensive markets. So talking about financing, where I come in, because, of course, we run a mortgage lending company, and we have offices here in California and in Dallas market. One thing, there are a few things which are different for investment properties, and then some things which are same, whether you're buying an investment property or buying it for primary residence. And some of the things which are different, we'll talk about that, and then probably briefly we'll talk about some of the things which are not different, which basically stays the same. One, there is a mandatory 20% down payment, and in some cases it could even be 25. But that's what you're looking at. So you can get, say, an FHA loan at 3.5% or a conventional financing at 5% down payment. Those options are not available when you're buying an investment property. So understand that. So if you're, say, buying a $150,000 property, make sure you have $30,000 to put down, maybe another $3,000, $4,000 for closing costs. That's going to be your upfront investment into the property. There are both fixed and variable rate available. But again, from my experience, when you're buying an investment property, I do not recommend going into variable rate, because what you're looking at is that you're trying to get a predictable cash flow over the next several years. And if you get into a variable rate, it might fool you, because you could think that, hey, you're getting a much better cash flow, only to realize that 5 or 7 years down the road, your rate went up, and now suddenly your cash flow equation goes completely awry, because now your payments have gone up and cash flow numbers do not make sense. So again, for the predictability of your cash flow, it makes sense to take a fixed rate, because then you're assured of what your mortgage payment is going to be for next 15, 20, or 30 years. But your rent could go up in the future, so your cash flow situation can actually improve as we go along. And that would make total sense, especially right now when the rates are so low, and you could still get rates, 30-year fixed rates under 5%, so that totally makes sense. However, interest rates are typically 0.375% higher than primary residence. So say if the going rate is 4.25%, on primary residence you're looking at 4.625, in some cases even 0.5% higher. If you put 25% down, you do get slightly better pricing than 20% down. Also, there are reserves requirements. So if you're buying primary residence, more often than not, there are no reserves requirement, which means that if you have to put $50,000 down and you can show that you have $50,000 in bank, you're good. You don't really need to show more money. But if you're buying an investment property, then we do count your primary residence mortgage payment or the entire housing payment, plus the future payment that you will have to pay on the investment property, and then can be 4 to 6 months of reserves requirement. So if your total, say, housing payment on your primary residence plus the investment property is going to be $3,000, you may be required to show anything from, say, $12,000 to $18,000 in the bank. And again, that does not have to be liquid. Say if you have a 401k account, we can use 60% of that. So you do have that option, but that is a requirement that would come in when you're buying an investment property. Also, a lot of banks do not allow this, which is 75% of future rental income. We can use that as qualifying income. they would require you to have 2 years of landlord history, meaning if you do not already own an investment property which has been rented for 2 years, they would not consider a future rental income as qualifying income. But we do that. We are both a direct lender and mortgage broker, so we have access to over 50 lenders that we work with. So some of our lenders would allow that, which means that say if your future rental from this house that you're buying is going to be say $1,000, we will consider $750 as an income that we can add to your qualifying income. And sometimes that helps a lot. I'm just working on a client right now who's buying 2 investment properties, and he's maxed out on his debt to income ratio, but because we are able to use future rental income as his qualifying income, he's able to qualify. So that comes in handy. Also, most of the lenders or banks do not finance more than 4 properties, and we can finance up to 10. And that's something that you should know, because especially if you're investing in a market where, as Sanjay mentioned just a few minutes back, that some of his clients have 8 to 10 properties. And of course, you can pay cash down if you have that much money. But if you do not, and if you want to keep your investments low, you would like to finance as many as you can. And so, yeah, just wanted you to have that information that yes, you can finance up to 10 properties, which is huge, because if this is the direction you want to go into in the future, then getting finance even with slightly higher rate makes more sense than putting your entire money as cash into the investment. The other things that do not change when you're trying to finance an investment property is that everything else, like we say that we qualify you based on 4 things, which is employment, income, credit, and assets. And those requirements remain there, as in you still need to be employed, you still need to have income. Immigration status is not that big a deal. You can be on an H-1B, you can be on an EAD, you do not need to have a green card, or you do not need to be a U.S. citizen to buy these investment properties. And in some cases, if you're listening to this and you're self-employed, we have even been able to do a few transactions with less than 2 years of self-employment history, which is kind of unheard of in the lending world, because that's kind of considered a bare basic requirement to qualify. So I know that a lot of our audience is self-employed, and if that's the case, then on a case-by-case basis, we can even look at that. So that's, I think, basically how financing is a little different on investment property than a primary residence. It's something that you should be aware of, because that does reduce your investment upfront into the transaction. With that in mind, what we have covered so far is that we have taught you some of the basics of real estate investing, why it is important, the leverage factor of investing. And then Sanjay went through his 7-point checklist and mentioned how we should be looking at that while we are considering real estate investing. He also mentioned about why Dallas market makes so much sense, because of the employers moving there, because of a still tight inventory, and the return on investment that you can get in those markets, and also relatively lower upfront cash investment that you get. I just finished talking about how you can finance these properties when you're buying it, what kind of down payment are we looking at, what kind of interest rates and reserve requirement. So the next logical step for us is to see that if you've figured out how to buy something, if you've figured out how to finance something, then what are the tax implications on this? So if I'm buying an investment property, is it different than primary residence? Or what are some of the other benefits that I can get? Or what are the other implications that we have? As we also have clients talking about what if we move the ownership into a company name. And for that, to talk about all that, because I don't understand half of that, but I have another esteemed panelist here who is, of course, my personal CPA. But if I have any questions about taxation, whether it's in the U.S. or even India taxation issue, the only person that I go to in the entire country is Sudhir Pai. He is, of course, a CPA, an FCA, an EA, CGMA, and with tons of experience. It's almost 2 decades of experience. He worked for Infosys for a long time and has been a receiver of top awards from the big guns like Narayan Murthy and Nandan Nilekani. So without further ado, I will get Sudhir on the line here. He is, of course, also the founder and CEO of several companies, including My Tax Filer, My Startup CFO, and Sudhir Pai CPA. And he will teach us about when you're investing in real estate, what are the tax implications. And pay very, very close attention to this, because sometimes I find these little difficult to digest or little difficult to understand. But understanding this will be the difference between what cash flow you think you could be making versus what cash flow you could eventually make, because some of these numbers are really, really staggering. So, Sudhir, if you can hear me, if you can take over the presentation and talk us through some of the tax benefits and implications of buying real estate investment property.
Certainly, Shashank, and that's a great presentation so far by you and Sanjay. And just about the Dallas market to start with, I myself was an immigrant from the Bay Area in 2003 when I saw the Dallas market. I very clearly understood that this market is going to boom. And at this point of time, looking at all the things that are happening in the market here, being a local resident of Plano, I see a lot of potential in this market. And I think the next 5 years is going to be a bigger boom than the last 5 years. That is my personal opinion. And I think it is going to happen because the last 5 years has worked in my favor. And I think the next 5 years is going to work as well. Coming to the amount of inventory that are there, as Sanjay mentioned, there are a lot of other new cities that are coming up, and there is a good rental market in all these different cities. And buying and investing in a property for investment, I think really makes sense. So this is certainly a place to invest, and I think it will be a good investment. And with the expertise from Shashank and Sanjay, certainly we can put a package together and make sure that there is an investment property meant for you, which will grow well, and exiting out of that at some point in time and getting into multiple real estate properties is certainly a great possibility here. So before I start my presentation on taxes, which I think is, I personally think is not the most entertaining part of this session, but still I think it's the most important one. And there are a lot of myths going around, and people think that they cannot invest in real estate in the United States. People living in the US, they feel that investing in real estate is a complex thing. From a tax point of view, it just complicates their tax return. So nothing of that kind. So I would certainly suggest that investing in real estate is the way to go after the primary residence. So the agenda for today's webinar is the tax implications of investment into the real estate market, and why is an entity formation for putting those real estate into the entity is very important from a protection of that asset point of view. And then foreigners investing in US real estate. As I said, there are myths around that foreigners cannot invest in the US real estate, but there are ways of doing it, and we'll also talk about the tax implications of doing that, and benefits of buying the property through business. Like a business owner, if he or she buys the property through the business, then what are the benefits of that? And then at the end, we will also talk about the DFW, which I covered to some extent. Sanjay did cover, and we can talk more and more about it because me and Sanjay are local residents of Dallas, and we love this place, and we can talk more and more on that part. So going to the next slide, investing in real estate comes in two forms. One is in residential real estate and commercial real estate. When I say residential, it is buying homes for investing, and the return on that is in the form of rental income or capital gains when it is sold. So for the rental property, there are passive loss rules that apply. When I say passive, what it means is that's not the active business. That's not something that you're actively doing. Real estate is not something that you're actively doing. So when you're not actively doing something, you are in a passive mode. And the rules of passive loss apply for such kind of a passive activity. And the exceptions to that are actively participating in that real estate activity or being a real estate professional like Sanjay is. Then there is also something called a grouping of activities, where there are multiple homes. You can group everything as one activity and group it as one activity and take some benefits of taxation. And then selling of rental property, there are also topics such as depreciation that comes into picture. and then computation of the net gain or loss from that rental property is also a tax planning activity which we can help you with. Then also there is something called as house flipping, wherein homes are bought and sold. Buy the house, make some improvements to it or repair it, and then sell it off. There are long-term and short-term capital gain implications on that. And business versus investment, buying homes frequently, and then selling them after making the required repairs on it is considered as a business where a lot of time is spent on that. Vis-a-vis if a person has a full-time W2 job and just buys a house, repairs it and keeps it, rents it out, sells it after 3 years, it's considered as an investment. So the tax implication on business type of real estate in the investing area versus purely as an investment of a real estate has got different tax implications. And two other topics related to real estate investing is conversion of primary residence into rental real estate. So when such kind of conversions happen, there are tax implications to it. So typically you're not able to sell a house when you move into a new primary residence. So how many years can you still enjoy the exclusion from sale of primary real estate? That's one point. So you can do it over a period of 3 years after renting it out. And then there is also something called as a like-kind exchange, where one house is swapped to buy another house. So in such a situation, the income that is there from sale of that house can be deferred or postponed till the new house is sold. So basically, one of the good tax planning vehicles for rental real estate investors is you buy a house, use the like-kind exchange, sell it off, not pay taxes. Second house is also sold off in similar manner. So you keep doing that and pay taxes only when you are cashing out of that particular real estate. So these are some of the topics, and we talked about active activity as well as passive activity. So what are the tax implications of being passive, which is what the IRS treats any real estate investment as? So in case of a passive activity, losses can be deducted only up to the extent of passive income. Meaning, say if you make income from house A to the extent of $10,000, and on house B you incur a loss of $10,000, then you don't pay any taxes. Whereas if you have income of $10,000 from home A and you have a W2 income of say $100,000, you will not be able to take any losses from home B against your W2 income. So that is passive activity. So passive activity, passive losses can be only taken against passive income, and passive losses cannot be adjusted against other types of income. So that's the downside of being just an investor, and not an active participant. Now, what is active participation? And with active participation, the person can take about $25,000 in case of married filing joint status, or $12,500 in case of single status from other income. So there are certainly limitations on that, certain restrictions on that, but more or less this is what applies. $25,000 can be taken as an adjustment against other income. And to be in active participation, the person should be taking management decisions about renting the house, keeping it available for for the next tenant and things like that. And that's where most of my clients fall into this group, where they're actively managing it but not materially participating in it, which means they are not doing anything more than just finding a tenant and placing the tenant there. And the only losses that they can take in such a situation is up to $25,000 from their other income, if they are filing a married filing joint return. Now, what does material participation means? Material participation means where the primary activity of the taxpayer is rental real estate. And I have a lot of such clients who are fully into real estate. They don't have their full-time job, and they just make sure that they buy enough homes and they rent it out, so there is a good amount of income flowing for their sustenance as well as for growth. And with the house, with the depreciation that one can claim, there is equity in the house, and equity and then the net cash flow, is what can make the person get full-time into this kind of a role. Also, I have seen instances where the taxpayer is a full-time, employee, and the spouse is into full-time real estate. And one other ways of making this a full-time real estate profession is to get a license from the state, a real estate license from the state, and I'm sure Sanjay will be more than happy to add as many agents to his network. And then Sanjay has been very successful in doing that. And what happens with that, when you're a real estate professional with the license and you spend 50% of your time in the real estate trades or business, and more than 750 hours were devoted to that particular activity, then the person is considered to be materially participating in the real estate activity. And with this, what happens, the losses that comes out of the house or the investment property, you can take an unlimited loss against your other income. So let me give you a small example. Husband makes $100,000 and the wife is into real estate profession with the license, and the house along with the depreciation. See, depreciation is the catch here. With depreciation, a lot of losses can be generated, and also with other expenses plus depreciation, losses can be generated. That loss goes against the husband's W-2. Let's say 30,000 is the loss. So the net income on which taxes are paid is $70,000. So, taxes are saved, equity is built, you own a home, you are getting a cash flow. So there are all the benefits. So, there are these benefits out of, investing in real estate property. So, tax planning plays a big role, and that's why we decided to include tax planning in this particular discussion. So building equity, paying less taxes, and making your cash flow positive is all about rental real estate. So going to the next slide, Shashank. Entity formation, one of the questions that keeps coming to me is, should I buy it in my personal name or should I put it under an entity? Now, there are also questions as to why is an entity required, because, an additional entity, giving birth to a new entity with the state, adds to the headache of, some more paperwork, more tax filing and all that. Now, the benefits that you get out of entity formation for protecting the asset, which is your real estate investment, is because, it puts that asset under that entity, and anybody having access to that asset when somebody pulls your social security number is not possible. Insurances are good, and it is a requirement, but just insurance may not be enough. So putting it under a formal entity, under a different tax identification number, can keep it away from the creditors, and planning it in such a way that, the entity ownership of it is with estate, the beneficiaries of which are the family members or relatives, is another way of protecting it beyond just forming an entity and putting the asset under that. And for businesses, a business, say let's take the business of a restaurant. The restaurant may not want to put the particular real estate into the operating company, which is the company which is issuing invoices or the receipts to the people who come and have food in that particular restaurant. It's not a good idea, because if something goes wrong with that particular guy who eats in that restaurant, you don't want that person to have a claim over the real estate asset that you hold or the big restaurant that you own. So putting it under a holding company and then having a separate operating company will take care of the liability of the business, and also make sure that the asset is under the personal name, and the risks of anybody eating it up is minimized. So those are the benefits, and always keeping personal separate and any business activity separate is the best thing to happen. It keeps the audit rates from the IRS low, and tax planning can be resorted, and then the asset is protected. So the cost of forming the entity to the benefits that you get from forming the entity, there is a big gap, and the benefits of forming the entity is really big. Going to the next slide, Shashank. Investment in US real estate by foreigners. So anybody who is not a US citizen, green card holder, or even a visa holder, H1 or L1 visa holders, a person sitting in India or sitting in any other country can invest into the US market. There is no problem with that. Forming an entity and then doing it through that entity is also a good way to do it, and that is something that we usually recommend that the person does. It is considered a passive activity. I explained the passive and active rules in my previous slides. So it is a passive activity even for those foreigners who invest in the US real estate, and there is a 30% withholding rate on the net income of the rental real estate. So if you have put the house or the commercial real estate into the entity, and on the net income, there has to be a tax withholding that needs to be done. The person who is the end user, owner, or the person who owns the entity will have to file a 1040 NR at the end of the year, and pay the taxes on the income that is generated from the United States. Now, there are treaties with multiple countries. India is one such country where any taxes that the person pays in the US on the income generated from the rental real estate or commercial real estate can be taken as a credit back in the home country. So, there is a little bit of tax planning involved there, and our objective is to make sure that you don't end up paying too much taxes on the net income that you make out of the rental income. And by default, the ownership of a real estate or real property in the US is considered a passive activity. Now, to make an election to make it active, there is a process to it, and we can help you with that, setting up of that conversion from passive to active with the IRS, and make sure that if you are really actively involved in the real estate profession sitting outside of the US, certainly that's a possibility as well. Going to the next slide, Shashank. Benefits of buying property through a business. I discussed about this a few minutes ago. Depreciation is one big part. Section 179 is one such depreciation methodology where a higher amount can be taken as a deduction. It used to be 500K in 2013. Thanks to Obamacare and all the changes that has happened last year, the rate has come down to 25K for the year 2014. And the depreciation rate for real estate, commercial real estate, or for rental real estate is 27.5 years, which means that the value of the property that you buy is deducted out of the net income to the extent of 27.5 years. Whatever is the amount that is prorated for that 27.5 years, that gets deducted from the income that you make from the real estate asset. Vehicles that are used, for the business, if you buy a property, business property, and then traveling between your two different locations, they can be deducted against your income as well. And if a home is purchased for the business, which is also a real estate property, then taking deduction towards the home office is certainly something that is a possibility and something that is very normal for a business owner. Next slide, Shashank. So we talked about buying home in Dallas. Sanjay touched on it, I touched on it, and certainly we all love this market, and this is the market which will grow for sure. It is a steady appreciation in this market. It is not like the state which Shashank belongs to. Here you say 30-40% growth in a year, and it can go down by the same percentage, right, Shashank? Dallas market is more steadier, and I think having a steady investment is one of the best financial managements that one can have.
Thanks so much, Sudhir, for putting on. There were 2 or 3 comments here that I would like to personally talk about, and maybe get Sanjay's feedback on that. So Sanjay, Sudhir is talking about a steady appreciation, 5% per month. Do you think that's sustainable? As in, every time I see that kind of an appreciation, I would probably see it still a little bit of stabilizing in the future. So what are your thoughts on that?
Shashank, I think right now what Sudhir has mentioned, that's what is happening in the marketplace, but I don't think it's sustainable month by month.
Okay.
But I would say overall, the growth is it's really, really good. And, we have seen it. In fact, the homes, which we have closed a couple of months ago, we already seeing that they have gone up by 5-7%. But I don't think it's going to go like every month by 5%. But in general, I mean, I do expect that it's going to be double digits growth in a year.
Perfect. There were a couple of other things that Sudhir mentioned. One about moving your real estate investment into an entity, which can be an LLC or some kind of corporation. Again, understand that from financing perspective, there are some lenders who would not allow you to do that. But if you're going through the financing through us, we have lenders who have no problem at all. You will still be liable for the loans. You will still be on the promissory note, and you as an individual is liable to make that payment, but you can move the title or the ownership into a corporation. And foreign investors, you talked about that. There could be some financing available. Those are very stringent guidelines, but if you are, say, listening to this and you are not in the U.S. or if your family is not in the U.S. and they are thinking of investing at some price ranges, there are some financing available on that. But let's move on to the next step of our presentation. We have about less than 10 minutes left on this now to stick to the time. And so we talked about most of the things here. We taught you why invest into real estate. We taught you how to find a real estate which is good for investment purposes, how to finance it, what are the implications or benefits of buying a home as an investment property. That leaves us with the final step of the process, which is once you have done everything, then the next logical step is the entire property management angle of it. How do you find a tenant? How do you manage the properties? Because a lot of people, the reason they don't buy it is because of all the potential headache that could happen once you have bought it. So I'll again get our expert back here. Sanjay, as I said, is not just a real estate broker. He also runs a property management company. So he will probably guide us over the next few minutes on what do you do after you have bought a house. What are some of the things that you need to do? So over to you, Sanjay, if you can teach our attendees here how to verify a tenant and what are some of the basics of property management.
Thanks, Shashank. Yeah, it's a very, very important to understand. I mean, we can suggest a good property, we can help you buy the good investment property, but if you don't manage it well, then really speaking, whatever the efforts we have done to get that property, it's all wasted. So having said that, it's very important when you're screening the tenant. And the way we help our clients that we, first of all, we list the property in MLS and everything, and we get the application. So we do the pre-screening. And so on the pre-screening, we would do like 3 things. We will go ahead and verify their rental history. The tenant has to fill their application, and they will fill all information there. So we will find out their rental history, where they were living in and what kind of rent they were paying in the past, how many occupants there, and stuff like that. Then we will verify their income and employment. So we want to make sure that whatever, like say if our rent, we are asking the rent, which is $1,500, you want to make sure that they have at least $4,500 as their income. And then also we need to understand whether, how long they're working for their current employer. And also what kind of liabilities they have, what kind of auto payments and stuff like that. And then the third thing, which is the reserves and liquid assets, is what kind of deposits they have in the bank account. I mean, are they month to month or, or what they have. So these are the 3 things we have. And if we think that, okay, the tenant or the applicant who has applied meets some of these criteria, then we'll go ahead and pull their credit, or we would ask them to, basically we'll get their consent to run their credit and background check. And if it doesn't qualify, if these 3 criteria doesn't meet our requirements, then we would just tell them that, okay, well, they don't meet it, and we are done. But if they meet all these criteria, then we go to the screening. So that means we will go ahead and run their credit check, we will run their background checks, criminal, public records, everything. So most of the time, when we go to the second step and we pull their credit and everything, and we present the credit report to our landlords, the first question they will, or the first thing, especially if somebody is a new investor, they will call me and they will say, oh, Sanjay, this guy has like pretty poor credit. I don't think we should be, talking to him. And at that time, I will tell them, well, why do you think that we should not be working with them? Because again, remember, if their credit is good, really speaking, either they're not our client, or even if they're our client, that's only for a short period of time. Because as soon as they will find the opportunity, they're going to move out. So personally speaking, I would prefer the client who have a little ding on their credit and where they won't be able to get the financing. However, if they don't have enough income, then definitely no. So that's why now on the pre-screening, we have already identified their rental, their income, and everything. So that is one thing. So having the bad credit is not a bad thing, especially in our situation. The second thing is we will look at their background. So many times you will see that they have felonies, they have the drug possession, arm, and stuff like that, or theft. That is another thing which come quite a bit. Again, we sorry, we have to see how long those felonies happen and what and how serious was it. And then the third thing, we will pay extra caution, or you have to be extra cautious for that, is the eviction, if they had any evictions. And personally speaking, if I see any evictions on their public record or their file, probably I'm gonna I ask my client to stay away from those people, because they have done in the past, and probably they may do it again. But these are the things which we pay special attention to it. So Shashank, that's it. Okay, and then the next one is the property management. So whether you should do it or you need the property management to run your real estate business. For most part, I would say if you're local and you have some time, you can do on your own. It's not a rocket science. You can do the property management. However, if you're out of state and if you don't have time to do things to your property, then probably it's a good idea to get the property management. But one thing I'll tell you is make sure that you're working with a good reputed property management company. And the reason being is, of course, the property management company is going to be charging you the management fees, and then any repairs which happen, you are responsible for those repairs. But sometimes they will also charge you the fee at the top of the fees. So they will, when they have to do any kind of like a repair work or something, they will ask you to pay extra for their services or something. Or like say if there is an eviction needed, then they will ask you to pay extra in addition to the actual cost. So those kind of things you have to make sure, if you're working with a property management company, ask them what are the additional bills they can hit with.
So Sanjay, will spend probably another minute on this, but if say someone is trying to manage property on their own, how do they do all this? Are there any websites they can pay into to do a credit and background check, or are they dependent on going through their real estate agent or broker? How does it work?
Well, Shashank, finding the good tenant, that part they have to rely on their broker. I don't think you can do any of these things yourself. So when, of course, there are a few other steps which I have not discussed in detail because of the time constant. Sure. But finding the good tenant, once we find the tenant, then we have to draw the lease. We have to make sure that you're, as a landlord, you are in compliance with the Texas Property Code. So as a realtor, we help our client to do all those things. But after the tenant is moved into the property, then what next? So that is where the property management will come into play. But this part, to find the good tenant and helping to find a good tenant and then drawing the lease and everything, that's a responsibility of the broker.
Okay, so what kind of cost are we talking here? I know it varies from places to places and the kind of investors you're working with, but if someone were to use your service or the market rate, I don't know, but if someone were to use a property management company, what are we talking about? So if I'm trying to buy something, I'm making my calculation, how much money should I put into property management fees?
Well, the way we do it is, Shashank, if if the rent is more than $1,500, we charge 8% of your monthly rent, and if it's less than $1,500, then we charge 10%. And as a landlord, you're still responsible for any kind of a repair bills and anything like that. Sure, but we don't charge anything at the top of it. If there is a evictions needed, we will go ahead and take care of it. The only thing you have to pay is the court fees or any kind of actual fees, but nothing extra we charge in addition to the property management fee which we collect.
Well, that's That's quite cool. So you will even do evictions without charging anything additional on top of the court and the legal fees?
No, we don't charge any of those things, and most of the time, I mean, we have done like 3-4 evictions in the past, but most of the time, if you, if you do your due diligence properly, you don't end up with those situations. But again, once in a while it happens, but we don't charge anything extra other than just the court fees.
Sure, perfect. So let's move on to probably the final part of the presentation. We have taken you through everything so far. We have taught you how to the basics of real estate investing, how to find a good real estate investment property, how to finance it, look at the tax implications, maybe move it into an entity, and then how to manage the property either yourself or through a property management company. Finally, I wanted to throw in some numbers here because I know a lot of us want to do some analysis and crunch some numbers. Just wanted to give you a basic understanding of how the return on investment works on investment property. Again, we won't get into the details of the minor details of some of the other things, but at a very broad level, at a very macro level, say if you're looking at, sorry about that, a purchase price of $150,000, you have a down payment of $30,000, which is 20%. That's your loan amount, $120,000. The rate on a 20% could be anything between 4.5 to 4.75. I've gone slightly higher on that. That's your mortgage payment. These are ballpark, again, estimates of your property taxes, home insurance. That's your total payment. And then would it be fair to say, Sanjay, that if you're buying a $150,000 property in the Dallas-Fort Worth area, you're looking at $1,250 to $1,300 kind of rental income?
Yeah, Shashank, that's in fact, we target the properties with like close to 1%. So $150,000 property, I would expect, we used to expect around $1,400, $1,500. Now because the values have gone up, I would say probably $1,300 or $1,275. That is absolutely, it's a pretty conservative number, I would say.
Okay, so I think that's also conservative because I wanted to budget for some maintenance costs that the property could have. So just went a little conservative in there. That gives you the gross income per month and then the gross income per year. So you're basically making $2,538 out of an investment of $30,000. But Sudhir, walk me through this because I know that that's about 8.5% return on investment. But because of the depreciation factor, this entire income can be tax-free. How does that work? How does the depreciation angle work? How do you adjust the income and how do you get to almost a tax-free income on this thing?
Yeah, good question, Shashank. So basically what happens is when you try to do the computation of the net income for tax purposes, there is a benefit of depreciation deduction that can also be taken into consideration. And the depreciation rate for rental real estate property is 27.5 years, which means in this particular case, we are talking about $150,000 of purchase price. Over a period of 27.5 years comes to $5,455 of depreciation. So if the income is $2,538 and if your depreciation is $5,400, then there is a loss factor which can be taken as a deduction against the income that the person earns through salary or business income. And that effectively reduces other income also. So assuming that the person is in the 30% tax rate, we are looking at saving about $900 overall on top of not paying any taxes on this income. So net, yeah.
So Sudhir, that's almost that's a jaw-dropping number right there because what I'm arriving at here is that. So if I'm if you're making 8.5%, even 7% conservatively because you may have a property management cost or whatever built into it, that's essentially, are you saying that's more like a 10 to 11% return on investment or anything else because this is tax-free?
That's right. That's right. So this is tax-free is one. And on top of that, if the person qualifies to take the deduction of the losses, because if you see the numbers here, the depreciation is coming to $5,400. And the income is coming to $2,500. So the differential can work as an adjustment against the other income that the person earns. Wow. Now, in a normal scenario, the person making $150,000 of W2 income or a salary income, this loss that is getting generated from the house can also be taken as a deduction from the W2 income. Now, because of that loss deduction, the taxes on that losses also is a positive number which can add to your return on investment. If you try to make it, the most accurate number or the most aggressive number, I would say the return on investment would be anywhere between 10 to 12%.
Wow, 10 to 12% return on investment, and that's an yearly return on investment. So if they were to sell this thing, say, few years down the road, and that 150 purchase price resulted into, I don't know, 170, 180, then that's an additional ROI on top of the yearly ROI. Is that a fair statement, Sudhir?
That's right. That's right. And the taxes that the person would pay on that gain of that $20,000 or $30,000 at the time of exiting would be 15 or 20%, not even the regular tax rate, because it's treated as a capital gain.
So I guess if you're listening to this, this must be probably the most profound slide in terms of understanding how investment property works and how you treat it like a business. And I think the entire, when Sudhir told me some time back about the depreciation angle and how that's counted, I thought that was a game changer, because that suddenly jumps your ROI from 7 to 8% to maybe 11 to 12%. And that completely changes the game in terms of, and your investment is not quite that big. And Sanjay would tell you that finding the property in the range of 150,000 in the Dallas Fort Worth market is not difficult at all. As long as you can get the rental, which is about 1,250 to 1,300, which I'm sure he can help out with. So
and one of the points that I would like to add here, and I'm sure Sanjay would agree to this, is typically what happens, Shashank, the first house is always a change management thing, and that goes to your primary residence. The second house is also a little bit of a change management, because now you're thinking of adding to your cost, and you always take it very conservatively that you may not find a tenant. But after you cross those two bridges, getting into second, third, fourth, fifth rental real estate property can convert you into a businessman doing only rental income, running rental properties for a rental income. And there is another game changer over there. What happens in that situation is the person is then becoming a material participant in the rental activities, and the losses that get generated, because you would also have a lot more expenses than just running one home, and that material participation rules can in fact do a great benefit to tax planning.
Oh.
Okay. So I know your next slide is, talking about, going from 1 to 4 to 5 to 10. I think there is that benefit of, because the learning curve is gone, economies of scale kicks in, higher tax rate goes to lower tax rate because the loss carry forward. A lot of benefits are there indulging into real estate.
Great. So that was fabulous. I think the information from both you and Sanjay, I think that is a game changer, as we talked about the entire depreciation angle, and then becoming a real estate investor, so to say, from IRS eyes, and getting even further tax benefits. And I would like to be respectful of the time, because we did promise 60 minutes. We just ran a few minutes over. But the next thing that we would like you to do before we open it for question and answer is that we want to, there are several hundred people on this webinar, and we want to make sure to get back to all of you who are actually interested in taking the first step. So nothing fancy, but we created this URL, arcuslending.com/next step. There's a very basic form, just tells us your name, phone number, and who do you want who do you want to contact? Like, do you want to contact Sanjay, Sudhir, or me to take the next steps, or all of us? And so if you'll take next 60 seconds maybe to go there and just fill up your information so that we can get back to you. Otherwise, as I said, because of several hundred people on the webinar, we want to prioritize the people who do want to take the next step. Again, there is no obligation, it's just we follow up with you. And then let's come back once you've done that, and then we'll get into the question and answer. Here are the contact details while you're doing it. There's no point reading through it, but it's self-explanatory. And then you can reach to all three of us, or either of the three of us, depending on what you want to do next. So I'll leave the contact slide there for about 60 seconds, and then we'll move on to the question and answers. At this time, Sudhir, you can stop the recording if you want.
Yeah, sure.